So let's get into the combined financials of CEI and Viking. Now, this is very interesting. It took a while for the merger to happen, the reverse merger to happen, but it's finally here. These are the pro forma. These are the pro forma financials that CEI dropped, about 2 weeks ago. And now with CEI and Viking combined, the company is looking a lot more healthy. A lot more healthy. Now we still need to get our revenues up. We still have to sell our technology and products and whatnot. But the assets are up, liabilities are down, and we're just at a better position, especially on the New York Stock Exchange with the Amex. We finally, from what I'm hearing, we are finally on the equity. Like we finally are within the equity requirements, so we can stay on the exchange. So that's very huge. Looking at the financials, we have 90 million in assets. The liabilities 75.9 million. So that's net equity of 14.1 million. Our revenues at 14.4 million. Operating costs at negative 20.5 million. So there's an income loss from operations of about 6 million, 6.1 million. Now, for a growth company like this is, that's not bad at all. There's a lot of other companies out there that trade in at much higher multiples, very overvalued, that have higher income losses than what CEI currently has. So what James has been doing, lowering the debt, getting those assets under one roof, keeping the liabilities low when necessary, that's very positive moving forward. The shares outstanding right now, we understand that the preferred C shares could change things. We don't know how many preferred C shares are left in regards to common shares, but I know there's not a whole lot left. But right now, on most exchanges, we are sitting at 88.45 million for our float. Now we're talking about a net equity fair value. I like to use this valuation because it's very conservative. It doesn't really take in revenues. It doesn't take in growth prospects. It's literally assets minus liabilities over the shares outstanding. And that I use that because, say, if the company goes bankrupt and someone needs to buy out the company, what's the company worth base value? Very conservative, especially when we're in a bear market. We don't know what can happen. Obviously, there's other ways to evaluate things, and we'll get into that when they start selling product. But right now, we're just being conservative and staying at the baseline. And so right now, the net equity fair value, when you take that 4.1 million in net equity divided by the 88.45 million. Sorry about that, guys. For some reason, the live stream ended while I was presenting. I was on the call, so there was no reason for them to drop the call. Anyways, we'll finish up what we've been going through, and then we'll go along with our day. So where I was at, net equity fair value for CEI, it's going to be 14.1 million divided by 88.45 million, which is about 15 cents, almost 16 cents. Now on NYSE Amex, you need 20-cent threshold to be trading above so you don't receive a delisting notice. Now, hopefully we stay above that 20-cent mark due to our equity requirements that we fulfilled now with the reverse merger. So hopefully we don't have that issue. But it's nice to see that fair value-wise, just based off assets and liabilities, we're really close to that 20-cent threshold, and not like we were before with all those derivative shares, which hurt us, and why we needed to have that reverse split. Now, there's a valuation I sometimes like to use. It's when you exclude long-term debt. All right, when you exclude long-term debt. And so when you think about excluding long-term debt, think about how with long-term debt, you don't have to pay that within that current year or 12 months. So you just keep kicking it down the road. You only pay the debt that you need to pay within that year. So that works with the current liabilities, right? And so, what it is called when you see it in SEC filings and whatnot is the current portion of long-term debt, CPLTD, refers to the section of a company's balance sheet that records the total amount of long-term debt that must be paid within the current year. Right now for CEI, so the long-term debt net of current portion and debt discount is 37.56 million. That does not need to be paid in the current year. So think about this. When you take the total liabilities of 75.9 million minus the LTD NCP of 37.56 million, that leaves only 38.4 million in liabilities that we have to currently really account for. And so take the 90 million of assets minus that 38.4 million of liabilities. Now we're looking at 51.6 million in net equity. So now we're at a higher point when we're currently looking at the stock. Um, and so 51.6 million divided by 88.45 million equals about 58 cents. So you see the discrepancy. The price right now of CEI is about 30 cents. So it's almost double when you don't account for the long-term debt that we don't have to pay for the rest of the year. And so when you take that first net equity equation where we're sitting at almost 16 cents, you see we're kind of right in the middle. The market is kind of, in my opinion, adjusting it almost correctly now. Being that the preferred shares are almost done, I think the market's finally figuring out how to value CEI before the revenue starts to kick up. And just for gematria purposes, long-term debts net of current portion of long-term debt is not in the present year 333 in English reduction. Now the getting into the James Doris CEI interview notes after rewatching, I just have some bullet points that I took notes on when I rewatched it, because when I was doing the interview with James, I was more worried about keeping it smooth, making sure everything is going correctly. But when I rewatched it, I was able to pick up a lot more things, knowing that he's not really allowed to say specific things because it can't it can't move the stock price in any way. So you have to read between the lines, and I think I got a lot of good information that we were able to. So these are some of the notes. Commercialization of product line is key focus now moving forward. We're in the commercial line now. We're trying to make money, right? So we're trying to finally make money. James wants 100% ownership of each branch of business when the timing's right. 60% of Simpson Maxwell right now, 51% of the ozone and grid technology. And so, someone in the comment section fact check me if that's not correct. I think that's what the ownership is right now with those two lines of business. James believes each division can stand on its own, possible spin-offs down the road. ESG carbon capture Holyoke team told James it should be complete in October. Things change. Don't hold your breath. But that's what they told James. Obviously, they could come back and say, hey, it's going to be a little while. But they said October, the Holyoke operation should be good to go. The Reno plant should be operational very soon. No official timetable. He says it's a first-class operation, has opportunity to bring in government subsidies. Other people's money is always better, obviously. Would make equity payment of transaction more palatable, in my opinion, if we do get some of that government funding. We always like government money. Look at Tesla. I mean, they've been funded by the government. That's the only reason why it's a company, in my opinion. The electric grid tech is patent protected on all corners. Former engineers from big corporations have built it. Unique technology that shouldn't be easily duplicated due to these patent protections. I'm excited about that. No one should be coming in and trying to steal our idea easily. So we should have a lot of runway once we start selling it. We get ingrained to the system, and we are not only the first movers, but we're the stalwarts in this segment, which hopefully will prove very fruitful very soon and long into the future.